Joining us again for another one of Michael's global liquidity updates. Over to you, Michael.
Good, thanks. Good afternoon, everybody. Welcome to another installment of the liquidity story. What I'm going to go through is some of the latest data. This is looking at end August data and basically making from that an assessment of what it means for markets and in particular some of the longer term implications of what's going on. The data as such, if you go through the August data, it pretty much highlighted three things, I think. One is that the euro area or European central banks generally have got the loosest policy stances of any central bank worldwide, of any central banks worldwide. Secondly, what you're seeing against that backdrop, kind of curiously in many ways, is that capital is leaving the US dollar and it's basically moving towards Europe, which is a curiosity given the very loose stance. And the third thing to say is that if you look across asset markets, or particularly, let me say, risk asset markets, there's no evidence as far as we can see of bubbles as yet. In certain places, one could argue that's probably true, or you're getting evidence maybe in certain tech areas, but generally risk assets don't look particularly inflated. Now, what I've done is to put 5 or 6 questions up here to basically pose as a way of sort of looking at liquidity as a way of answering these. And let me just sort of flick through these one by one, and then I'm going to come back with some evidence of from the data as to try and prove or disprove each particular area. The first of those is, are we seeing a V-shaped rebound in markets and economies? Our view has always been yes. I mean, right from the outset, we said that the monetary response that central banks engaged was likely to cause a sharp rebound in markets, and that would translate into economies. We could, debate whether the level of the economy gets back to where it was in January, February of this year or not, but basically we are seeing a V-shaped recovery. The second question is, has there been a sea change in monetary policy worldwide? I think the clear answer is yes. There's certainly been 2. I would say those 2 are what the Federal Reserve has done by effectively junking its prior Phillips curve framework for basically hitting anticipated inflation pickups. In other words, to be a step ahead of the curve. That seems to have completely gone now. They've now emphasized their employment target as the main focus of monetary policy. And the second is, I think, a sort of an implicit but probably very widely recognized feature that modern monetary theory, or just basically monetizing deficits, is the way forward in almost every country. But I think there's a third one, and the third one probably has evolved a little bit over a little bit longer time, but it's equally as important. And that is, I think you're getting the formation of an Asian dollar. And you can see that more and more, even in the last few days and weeks, when many Asian central banks are intervening to basically stabilize their strengthening currencies against the US dollar. The Thai authorities are trying to stop the baht, moving through 31 baht to the dollar, for example. These are significant factors. The third thing is, will high street inflation restart? Our view is it's likely, because what you've got now is a combination of fiscal spending and a growth of retail monetary aggregates. This is a big difference with what happened in the GFC or post the GFC. What you saw there was the growth of wholesale money that largely went into asset markets. This is retail money that's waiting to be spent. And therefore the inflationary implications of that, I think, are much starker. Is the dollar peaking? I think it's likely, because what the evidence shows from capital flows is a major migration out of US dollar assets. At the moment, it's going into European assets, but it looks as if some money is starting to trickle towards Asia as well. Has there been a long-term GDP trend slowdown, or has it quickened? I think this is an interesting point to debate. But our view would probably be that, in fact, in many ways, it may well have been quickened. And you can look at that in terms of in different dimensions. But one of them is the growth in the use or take-up of technology. And I think one of the things that COVID is likely to do is to basically digitize or make the economy much more technology friendly. And that has to be a route to more and faster productivity growth. Are equities in a bubble? No evidence at all of that as far as we can see. Maybe there are pockets in certain areas, but generally not. Are bonds still safe assets, which is probably in many ways the most important question? I think the answer to that is no, no, and no. And let me try and expand a little bit more on these factors. In terms of liquidity, what does the liquidity cycle look like? Well, what you've got here is our standard diagram. This is an index of liquidity that goes right back to 1965. It ranges between 0 and 100. Periods of above average liquidity is signaled in that sort of white area of the chart, and periods where liquidity is tighter and markets become stickier or poorer performers is in the gray area. What you've had, certainly since the beginning of the COVID crisis, but actually beginning in late 2019, around the summer with the Federal Reserve's response to the repo crisis, is that liquidity has started to catapult in or rocket in at a very furious rate. There is some evidence that liquidity is beginning to roll over as some of the impetus falls away. I think one can cite as particular examples of that the flatlining of the Fed balance sheet. I don't think that's deliberate. That's more a factor that if you look at the backdrop for what the Fed is doing, what you've seen is swap lines to foreign central banks. In other words, the provision of dollars fall away because there's just no need for dollars now. There are ample amounts of dollars in the system, and the world economy or the cross-border markets don't want them. And secondly, if you look at a lot of the COVID-orientated credit support mechanisms that the Federal Reserve and the federal authorities promised, the take-up of those, which was originally slated to be in the trillions, is actually only coming in at barely 100 billion. So that either tells us that there's been a slow take-up, or the fact that the US economy is in rather better shape than many people originally expected. In terms of the mechanism of how this is being carried on, these two charts basically put that same evidence in dollar terms. The left-hand chart is looking at what central banks are doing, and we've split out the US Federal Reserve from the other non-US major central banks. And you can see that right now, almost everyone is participating. The US is probably about sort of 2/3 of that impetus, but it's other central banks, particularly the ECB, are taking up the momentum as well. On the right-hand chart, you can see there the impact of private sector liquidity. That is being maintained. A lot of people have sort of had the view that what you would likely see in the wake of the COVID crisis, rather like you saw in 2008-9, is that private sector liquidity will initially surge as corporations drew down credit lines, but then it would ultimately disappear as they repaid those over time, or there were short-term lines of credit. Actually, what seems to be the case is that those credit lines were drawn down. Some of them were repaid, but there's actually new lending which is coming through as well. And that can be seen very generally across the world economy. So private sector liquidity is actually picking up quite noticeably as well. And that is part and parcel of the whole story of fiscal spending playing a much, much bigger role this time than it did after the GFC in 2008, 2009. Also, what you've got to say from this chart, or these four charts that we show here for the US, is the contrast in the size of the monetary response between GFC and the COVID crisis. The yellow lines are basically looking generally at what you've seen in the COVID response. The answer is that that's been about 5 times the liquidity injection that we saw in the GFC1 back in 2008-9. The lower two charts are basically looking at something a little bit or subtly different. The left-hand chart is looking at the inflows into US institutional money market funds, and the right-hand chart is contrasting broad liquidity growth, which includes wholesale aggregates, with M1, which is narrow money or basically retail aggregates. The left-hand lower chart first, what does that show? It basically shows how much investors panicked at the time of the COVID crisis and pulled money out of Wall Street and put it into money market funds. A lot of that money has since gone back, but actually what you can see is that money market funds are still pretty flush with liquidity. An anecdote that we've mentioned a couple of times before, but I think it's a really instructive one, is that one of our clients in the US told us that according to Fidelity, something like 20% of their account holders sold every equity they held in March of this year, rather, when the COVID crisis struck. I mean, that is an unbelievable statistic, if that's correct. If you look at the lower right-hand chart, that basically is saying that retail money is just growing faster now. That's very different from what we saw in the GFC1, that money is coming into retail bank accounts and it's likely to be spent. That's the key thing. So consumer spending is likely to maintain momentum as we move into 2021, and that is likely, we think, to cause more inflation. Where is money moving at the margin? Well, you can see this chart, which basically on the left-hand slide shows the stock of liquidity, or rather the flow relative to average, and then the change in the flow over 6 months on the right-hand chart. What that basically tells us is that pretty much everybody apart from China is injecting liquidity into the system. The Chinese have been sitting on their hands, and I'll come back to the reasons maybe why that is towards the end. But everybody else is injecting liquidity. And as you see from the right-hand chart, at the margin, it basically is the European central banks that are basically pushing more cash in, and that's being led by the UK. And that's something I think to bear in mind when you look at the valuation of the UK stock market. This heat map on slide 7 is basically then looking at which are the central banks that are easy and tight, and how generally that picture has changed. I think the conclusion there is again pretty obvious, concurring with that previous bar chart, and that is that all central banks are basically moving into that green loose area. They did that around March of this year. Some it took until April. The Chinese are not. That's the orange band in the middle. Emerging markets, which are dominated by China, you can see on that third row down. So that's turning a sort of palish green. And India, which is at the bottom of the chart, is not really doing as much as some of the others, but it is easing. And that maybe tells us why, in some ways, the Indian market has been languishing a bit. This chart, or these two pie charts, are kind of interesting because it looks at what have been the contributions in terms of dollars to the increases in global liquidity. First of all, on the top left area, since the COVID crisis, and then for reference in the bottom right, since the GFC. Now, maybe let's start with the GFC period. You can see there that by far and away the biggest increase by any stretch is Chinese private sector liquidity. And Chinese private sector liquidity contributed about 60% of the entire increase in global liquidity from the GFC until the beginning of the COVID crisis. And we know that. I mean, I suppose that's one of the fears that many people have had, that the Chinese crisis is about to embark and a Chinese bubble has been blowing, etc., etc. But the important thing to say is that's been the Chinese private sector, that's been Chinese shadow banks, etc., that have been the major cause of that. In that period as well, the strength in the dollar subtracted about 20% from the growth in global liquidity that otherwise would have happened. And you can see that in that slice of the pie around about 11 o'clock, that says minus 19.7. Elsewhere, the picture was sort of fairly mixed. If you look at what's happened since the COVID crisis, the balances are much more even. The Federal Reserve's provided about 10% of the liquidity. The fall in the dollar has had the effect of actually increasing global liquidity by just over 15%. Chinese private sector liquidity has been, not bad still, but the People's Bank, as you can see, that little slice around 2-3 o'clock on the pie chart is basically negative. The People's Bank has actually taken liquidity out through this period. Now that's kind of mysterious, but I think it comes back to the People's Banks or the Chinese currency policy that I'll come to towards the end. You can see that evidence of what the Chinese have been doing by looking at the right-hand chart. Just for information, the left-hand chart is simply looking at weekly data on liquidity to try and show that it is maybe foreshadowing a little bit more of a slowdown coming in global liquidity, but broadly we're still at high rates. The right-hand chart is looking at what the People's Bank is doing. And the main point that we've made over the last few years is that Chinese monetary policy changed around 2015, where they basically began to pursue a much more active domestic monetary policy stance. And consequently, we've been arguing ever since that People's Bank watching, PBOC watching, is really a critical skill to develop. The People's Bank is, well, actually now the second biggest bank in the world. It was then the biggest in 2015. It's now been eclipsed by the Federal Reserve balance sheet, but it's still up there. And what you've seen more or less over the course of the last 2 years or so, but being reinforced over recent months, is that the balance sheet has flatlined largely because the domestic asset component, which is effectively domestic monetary open market operations, has not done anything. They've deliberately maintained this cap on central bank money. Now, why are the Chinese doing this? Well, if you look at evidence of how they operate monetary policy, this is typically how they act when they want to maintain stability in the yuan. And through the back door, they will supply banks, state-owned banks, with extra impetus or ability to lend, maybe through directives or lower reserve requirements. And that will basically enable the economy to maintain growth or stability through a period when they're operating very tight money markets. And they're doing this again now. So that tells us that they've been wanting the yuan to strengthen, and lo and behold, they seem to have achieved that. If you pull all these liquidity thoughts together, what does it mean for global asset markets? Now, I think this is a particularly interesting chart to look at. What it shows is the growth rate of global liquidity here in yellow, measured on that left-hand scale, and the red line is the growth or the return year-on-year change in world wealth. Now, world wealth here is a catch-all for absolutely everything. It's all financial assets in developed and emerging markets, including government bonds, corporate bonds, equities. It includes precious metals. It also includes housing, and we've taken real estate data from the BIS, and that is included in that as well. And what you can see is that there is a remarkable correlation between expansions in global liquidity and growth in world wealth. And therefore, it's been no surprise that asset markets have picked up. What you're seeing as well is not just equities rising, but you're also seeing precious metal prices rising. That is now extending out into industrial commodities. And what's more, you're beginning to see a pickup in many markets in the real estate area, particularly in the Eurozone, in the UK, and more particularly in the US. So all these features are starting to come through. It's a fairly standard response. And the gap between the yellow line and the red line is suggesting that asset markets have still got further to go. Now, what about real economies? Well, here is a chart that we often show, which is looking at the JP Morgan Market World PMI, and that is the orange bar alongside global liquidity advanced by 9 months. The clear takeaway here is that there's further recovery to come, and that's what we certainly expect. And that chart has more or less tracked as you would have expected. What's happening in the US particularly? Well, this evidence on slide 12 is basically looking at two measures The left-hand and the right-hand charts are the same data, but the right-hand chart is a much shorter window, higher frequency window, if you like. The red line is looking at US economic expectations. Now, what I've done for this is to take all the Federal Reserve regional surveys and the Michigan Consumer Sentiment Survey, and to basically compare the question on what is the current outlook compared to what is the expectation of the outlook in 6 months' time. And that has been often an extremely good benchmark for what the economy is set to do. And what you can see is that that has recovered dramatically. Alongside, we've put our US investors' risk appetite measure, which is a measure of the positioning that investors have in US risk assets. In other words, their exposure broadly to corporate debt and to Wall Street. And you can see that these two indicators have largely moved together. And that would more or less tell us that US asset markets are pricing this correctly at the moment. And it seems that they're more or less in line with what the economy is doing. And the economy is behaving as you'd expect, given the liquidity inflow. One big anomaly is this chart, which is looking at the UK. And the UK market is the one stock market that has not picked up really since the COVID crisis. It's still down about 20%, I think, year on year. You're looking at equities that are just not really doing very much. But I think there's a huge catch up to occur. And maybe it's because the UK has been saddled with this Brexit paranoia again, that people are just not looking at what's happening to the underlying economy. And what we show here is a very simple chart that basically maps out total UK liquidity, which is the yellow line, advanced by 12 months and plotted on top of UK industrial orders as calibrated by the Confederation of British Industry. This chart goes back to 2008. We've got it going back all the way back to the 1970s with exactly the same correlation as it happens. And unless something really odd has happened and the Martians have landed or whatever, God knows what, you're likely to see a significant rebound coming in UK industrial new orders, which basically augurs well, I would say, for the small mid-cap area of the UK and maybe the overall UK stock market. So this looks to be an anomaly that really is sticking out. The other thing I think one's got to say when one's looking at liquidity, and I've reproduced again the chart on the Developed World Business Outlook, the PMI and the Global Liquidity Index on the left, but actually to put this in a broader context and to map global liquidity against inflation prospects. Now, the inflation prospects that we've looked at here are actually just for the US as it happens, but it's the answer to the Purchasing Managers Index, the ISM Index, question on prices paid. That has been a very good lead indicator of US inflation pressures historically. And we've got this chart going right back to the mid-1960s. And what it shows is that liquidity here has been advanced by 15 months and put on top of that PMI prices paid question. And what it would suggest is you're going to see an uplift coming in US inflationary pressures. And that is a consequence, one would suspect, of rising commodity markets, lots of excess liquidity, and the fact that inflation is starting to pick up as a lead indicator in asset markets as well. What are central banks trying to do in all this? I think they're very simply trying to create monetary inflation. And if you look at this chart we've put here on the gold market, it basically spells out what is going on. And one of the ways that we've tried to explain this feature before is to say, let's think about inflation in terms of two components, two moving parts. One of those is a monetary inflation element, which is caused by central bank money printing or excessive central bank money printing. And the other is a cost inflation or a cost deflation component that is coming through from commodity prices, from technology, from demographics, from the China effect or whatever. Now, those two factors combine into high street prices. What you can see with the gold price is not a bad measure of the monetary inflation impact of central bank money printing. There have been two, arguably now three, periods of excessive monetary inflation. One in the 1970s, one in the 1980s and early 2000s, and one occurring now. The 1970s monetary inflation ended in high street inflation. Why? Because cost pressures actually moved in the same direction. And that was because we didn't have technology, we didn't have bad demographics, we didn't have China, but we did have OPEC. And OPEC matched the devaluation of the dollar with price hikes. And so we got a combination of monetary inflation and cost inflation, which came through viciously on the high street. In the late 1990s through the 2000s, you again saw a monetary inflation, but you had demographic pressures, you had China, you had technology, and all those factors basically meant that high street inflation was capped, whereas the bulk of the monetary inflation came through, therefore, in asset markets where those cost factors didn't really apply. What you're seeing now is maybe a hybrid of these two periods. What we've got is monetary inflation unquestionably. We've got a period whereby technology may still be running, demographics may still be there, commodity prices seem to be rising, not falling, and China's contribution to deflation may be a question mark. So what I would argue is you're going to see some mixture of asset price inflation and high street inflation. How much will the price of gold go up? In other words, how much should we expect of a monetary inflation? There are two ways to look at this. One is the top right-hand chart, which is looking at the gold stock to US debt. Now, if this is an equilibrium relationship, and that's a question to pose, the long run average has been about 20-25% ratio of the gold stock to the value of all US debt. And that seems to be some mean reverting tendency. If we go back from current levels to that average, the gold price would have to move to $2,500 an ounce, given that the stock of gold itself is fixed. So that's the way it's resolved. If you look at the lower chart, the blue line is the gold price in log terms. The gray line is US inflation, CPI, the trend in US CPI. And the orange line is the trend in US liquidity. Now, I would venture that the strongest correlation there is between liquidity and the price of gold and not inflation and the price of gold. And therefore, what I would argue is that the rapid expansion in US liquidity that we've been seeing is going to start to come through in a much higher gold price, and that will feed through into higher inflation. Now, this chart, or these two charts here, put some flesh on those bones in terms of what does it mean. The right-hand chart, first of all, is saying, look at the growth rate in US M2. Now, I've used M2 because that's the longest history. We've only got liquidity going back to the mid-60s, but this goes all the way back to 1915. Even in war times, we've never seen a monetary expansion of this scale. It is simply off the charts. You're looking at growth rates of at least 25% year on year, and that is being maintained. And what's more, if you look at the weekly data, recently it's been re-accelerating again. So this trend in higher monetary expansion is not going away, okay? I think it's going to feed through into higher high street inflation and a devaluation of paper money. And you can see on the the left-hand chart, what that means in terms of valuation of different assets. Now, our view has always been that the inflation rate is the key metric in terms of valuing financial assets. This chart, which is schematic, is actually taken from actual data that comes from a report we wrote maybe 5 to 10 years ago, but of that ilk. And what it basically says is that if you look at the bond markets, the valuation of bonds as on the left-hand scale, which is the inverted yield on the bond, is basically one way relative to inflation. So as inflation falls into deflation, you get this massive re-rating of bond markets upwards. So bond yields plunge, prices go up. And as inflation picks up, it works the other way, that bond markets basically collapse. If you look at real asset markets, commodities, real estate or whatever, you see the opposite. And those are sort of nice symmetric mirror images to say that more inflation is great for real assets, but lousy for bonds. If you look at equities, they're kind of in between. The equity line, which is the brown-orange line, sees a peak valuation at around 1 to 2% inflation. It falls away either side of that relatively slowly as you move from 2% to maybe 4, 5, 6% inflation. And then it starts to move down more rapidly. Now, what that really says to us is that in the early stages of an inflation pickup, such as we now may be getting, the equity markets are going to be probably one of the key assets to hold along with gold. Bond markets are not. So a near-term asset allocation has got to be more gold, hold on to equities, and get out of government bonds. They are the risk that's out there. Now, is there a bubble yet in equities, which is an initial question, and I'll answer this again a little bit later using risk appetite data. But these two charts, first of all, look at the ratio between equity assets worldwide, the total value of all holdings, relative to safe assets. Safe assets here are defined as total liquid assets, in other words, bank deposit accounts and money market funds, plus government bonds and AAA corporate credits. And what that says is that doesn't look to be any great evidence of a bubble. I mean, it's charts elevated, but it's really in a normal range. And if you add in the projection of central bank balance sheet increase and government bond issuance to the end of the year, it would suggest we're actually maybe going down again to a more sustainable level. If you look at it more simply in terms of the ratio of equity assets to overall global liquidity, on the right-hand chart, where's the bubble? There's no evidence at all of this. Okay, you can see historic bubbles. There was a bubble in 1999-2000, the Y2K one, where you got that ratio up to about 0.85. We're currently about 0.51, which is the long-term average. In 2008, we got up to 0.7. But there doesn't seem to be any great evidence here of a bubble in equity assets. In other words, equities are still climbing this wall of worry where people are still very skeptical. They're nervous about the economy, but the equity market is not the economy. Bond markets, on the other hand, look very richly priced. And, you can cut this many ways, but the easiest way, I think, or the most straightforward way to see what's going on is to look at these two charts, which are looking at the 10-year term premia on the US Treasury government bond. And what we show is on the left, the term premia measured on that left-hand scale in terms of percentages. And the gray bars are looking at QE periods. Now, every time there was a QE period, like now, you tend to see the term premia rising. When you see non-QE periods, historically, actually the term premia has collapsed. We should be seeing much, much bigger gains in term premia, but maybe de facto yield curve control or words by the Fed are actually keeping investors in bonds. If you look at the right-hand chart, this is even more stark, where we show the same data on the term premia, but now we graph alongside not just liquidity, but we actually look at the growth rate of all safe assets in the US, and we've projected through to year end what that growth rate will look like, the red line, based on what the slated bond issuance is going to be and what projections of the Fed balance sheet will be. That gap is yawning, and it's saying that investors have got to get out of bonds and more into equities. And broadly, that is a message which I thought was a warning sign to say how badly mispriced the bond markets are. To put it in another way, the term premia currently is about minus 150 basis points. So if it goes back to its long-term average of 0, you've got to add 150 basis points to US bond yields, which puts the 10-year Treasury at just above 2%. and that's where I think it should be. Now, you can see this in another way by tracking liquidity against the yield curve. The red line on this chart is the 10-2 yield curve. The yellow line is US liquidity. And what it basically says is that every time you see a liquidity expansion, liquidity here has been shifted on by 12 months, by 9 months. And what it illustrates is that there's a very, very close correlation between gyrations in the liquidity cycle and movements in the slope of the yield curve. And that explanation is driven by the term premium we just looked at. Now, what you can say at best is that the inflection in the yield curve has been foreshadowed or predicted by the pickup in liquidity, but the yield curve should be a lot steeper now than it currently is. And again, that figure of 150 basis points comes in because we should be looking at a yield curve that is near a 2% gradient rather than the 60 basis points or so that we've got at the moment. So this is another way of saying that yield curve control or de facto yield curve control is making a difference. But at some stage, foreigners are going to start to get rid of their US government debt and domestic investors are going to start shifting into other assets. Interestingly enough, foreign ownership of the US Treasury market is 40% currently. The Chinese own the biggest slice, and in the last 10 days, the Chinese have stated that they're going to sell down $200 billion of their US Treasury holdings. Others likely will follow. What does that mean for the dollar? Well, in our view, the dollar is seeing some sort of inflection. The way that we get to that impression is by looking at the quality mix of US liquidity. And I've gone through this many times before, but basically the difference between our view of currencies and maybe the consensus view is that we discriminate between the types of liquidity that are moving markets rather than aggregate everything into one bucket. So we distinguish private sector liquidity, which is good for a currency, from Federal Reserve liquidity, which is bad for a currency. And the overlap or the difference between the two is the critical thing to plot. Now, we can see what's happened to private sector liquidity and Fed liquidity on that left-hand graph. The periods where the yellow line, private sector liquidity, is above Fed liquidity should be periods of dollar strength, and vice versa. When the red is above the yellow, the dollar should be weaker, and the red is just moving above the yellow right now. The chart on the right is plotting that differential. The Forex risk index is that differential. When the Forex risk index is above 0, that's telling us that in that case, what you've got is private sector liquidity above central bank liquidity. And the falling red line is currently telling us that the dollar is at risk. In other words, the pace of central bank liquidity is outpacing that of private sector. The yellow line on that chart is the trade-weighted US dollar, deviations from its 3-year trend. We haven't put year-on-year percentage changes on there because that's kind of cheating. This is lining up the two factors, and we've actually advanced the Forex risk index by 12 months to show what a good predictor it really is. Now, I want to dwell on this dollar story a little bit later, but before I get there, I'm just going to round off with a view of equities. Okay, so let me try and finish this by looking at this data. This is what I was basically trying to come onto, and hopefully this will. Hang on. Hopefully this will work. If you look at figure 5, what's going on right now is a picture whereby capital flow is leaving the US. And that is illustrated in this diagram by the black line that you can see here falling away. Broadly speaking, this chart is illustrating regional capital flows as a percentage of global liquidity. The black line is money moving into and out of the US. The yellow line is money moving into and out of China and Asia. And the red line is money moving into and out of the European economies, principally the Eurozone. What the data is largely telling us is that this period of spike here, where a lot of money moved into the US dollar, is basically reversing. And that period is one where you basically saw, or you've seen, a lot of appetite for safe assets. So this was when the Europeans were not issuing very much safe assets. Regulations were forcing European banks to hold more safe assets, and there was tremendous demand for US safe assets. Equally, as flight capital left China during this period in 2015, 2016, money went into US treasuries. And that spike is very evident, and that pushed up the dollar. What you're seeing is that flow now dissipating, and money is starting to come back into the euro area. If you look at the history of this red line, you can see that the European markets normally are in capital surplus, they attract capital. But the period since the Eurozone banking crisis has basically caused this dip, sharp dip, in money leaving the Eurozone. Now with the Eurozone governments issuing a lot more debt, and likely being that other regions, particularly China, will take up some of that debt, what you're likely to see is the red line expanding. Meanwhile, the black line will start to come down, and that would suggest to us that this is going to reinforce the downward trend in the US dollar. As the downward trend in the US dollar accelerates, the country that, or the currency that will be the biggest beneficiary of that fall in the dollar is likely to be the euro. Now, the reason we stress the euro, and I apologize for not being able to show the chart I was going to, but if you look at what's happening in terms of the currency space worldwide, the Europeans have got, there's very little the Europeans can do to stop the euro rising. They don't have the flexibility in monetary instruments. What's more, they don't, arguably, the ECB doesn't really have control or authority to guide the euro. All they can do is use what's called open mouth operations. And that's what the ECB has latterly been doing in the last few weeks to try and talk the euro down every time it gets near 120 euro to the dollar. And that's basically their best hope. We know that the euro area is more deflationary than most. And typically what happens is during periods whereby the world economy is growing subpar, you tend to find that money enters the euro and the euro strengthens. This is really happening on cue right now. Asian governments are increasingly targeting their currencies. And the chart that I wanted to show were a couple of charts, in fact, on the so-called Asian dollar. And the Asian dollar, which we construct, is basically a basket, a trade-weighted basket of all the major Asian units. Now, to put that into perspective, that has been flatlining since around 2017. And the biggest change has been the decisions by the Chinese and the Japanese to seemingly target their currencies against the US dollar, and for other peer currencies within Asia to copy them in terms of trying to match currency stability as a policy guideline. You can see that even in the last 2 or 3 weeks, where many governments, including India, Thailand, Taiwan, etc., have been intervening to hold their currencies down. And this is really a policy change, and the third big policy change that I wanted to highlight at the beginning. Now, the reason that's significant is that what you're likely to see is as the US creates more and more monetary inflation in the system to bail out the economy from the COVID crisis and to create a higher level of CPI inflation, so the dollar will devalue. But Asian policymakers are going with it, and they are deliberately monetizing. What's more, you're likely to see a diversion of foreign exchange reserves, principally in China, from US assets into European assets. And the Chinese have already given some hint that they may do that. So the end of the day is what you're likely to see is a euro that appreciates maybe significantly over the course of the next 2 to 3 years. and that is going to put huge strain or renewed strain on the European debt situation. And it's likely to cause a divergence within Europe between Germany, which is still the dynamic economy, and the peripheral countries. So if I summarize, and I may have to stop the sharing and go back to my video and try and do it that way, and apologize once again for the fact that for some reason the Zoom link here hasn't worked very well. But basically what we're saying is that if you come down to the nub of all this, we're seeing a deliberate liquidity expansion worldwide by central banks. They seem to have changed policy in at least three regards. Those policy changes are essentially, number one, to use more MMT, if you like, within the policy mix. Secondly, the fact that the US is junked the previous framework of using a Phillips curve to anticipate and hit rising inflation or pick up in inflation. And thirdly, the decision by many Asian governments to be targeting their currencies against the dollar, certainly, but more particularly against each other. If you look at currency volatility measures on this so-called Asian dollar basket, you go back to the 1980s and 90s, that notional Asian dollar would have had annualized volatility of about 8%. For the last decade, it would have been about 4%. And for the last 2 years, it's been down to 2%. So what you're seeing is currency volatility in the Asian region against peer units just dying away completely. And that suggests to us that this is a meaningful monetary policy move. What does it mean for asset allocation? Well, just to round off on what we think on that regard, the assets to buy are equities by far and away. You want more gold. You probably, if you want paper currencies, you want to be moving out of the dollar and more into the euro. The geographical split, we think that out of this, you're likely to see the UK has been a laggard. US is probably still okay. Eurozone potentially could catch up. But the problem the Eurozone's got is that it doesn't like, or equity markets don't like, a rising euro. Which leads me to sort of the finale, which is to say, if the gold price goes up in the manner that we suggest, which is up to about $2,500 an ounce, which is what all the stars seem to be aligning towards, what does it mean for emerging markets? Well, our reckoning is that if you get gold up to that level, in other words, gold up by 25% from where we are now, emerging markets could easily double from these levels, because the relationship between gold and commodity prices in emerging markets is historically very tight. And emerging markets have suffered unduly, perhaps, in the last 7 years from a combination of two factors. Number one is the fact that the dollar has been strong, and that now is reversing. And number two is the fact that China has been operating a tight monetary policy. The more that the dollar weakens, the more latitude China and other Asian governments have in easing monetary conditions. So let me finish on that and see if you've got any questions. And once again, to apologize for the inactivity of my Zoom presentation.
Thank you very much, Michael, and apologies to everyone for the technical difficulties. Again, if you have any questions, then feel free to put them down in the chat below. Thank you.
I will, of course, send the slides out. And if anyone has any questions or would like to listen to an uninterrupted version of this presentation again, we can always have another go. But that's where we are. If there are some questions, please put them in the chat. Or I understand if they're not.
Michael.
Yeah, hi, Stephen.
Yeah, how you going? Sorry for my rather appalling appearance.
No worry.
Michael, I just wanted to ask, you know, this idea that we can have a strong takeoff driven by liquidity and debt yield, term premia rise by, you know, upwards of 150 basis points, even higher. Is there a historic example where you see the term premium rise so sharply and you don't see a strong growth response, or indeed you see a weak growth response?
Well, I mean, the answer would be there's actually quite a near-term example, which is basically what happened after the GFC. Now, you could arguably say that the growth response that came out of the GFC was somewhat muted, but the recovery in term premium was actually quite sudden.
Yeah. Look, it's more, what I just wonder, is there a case in history, maybe even the last 120 years, where you just get the counter, you get almost a risk premium driven slowdown, or, even depression perhaps, because of the debt dynamics and perhaps the extent of exchange rate adjustments required to rebalance activity?
I'll have to think about that. I mean, the risk, or maybe what you're saying is, are we likely to see, or are we not likely to see any economic pickup here? And, ultimately, will that liquidity work? Are there some mechanisms whereby manipulation of the bond market can actually cause economic stagnation or stop, if you like, the normal transmission? And I think the answer is that there are certain circumstances where that could occur. And after the GFC was actually one particular instance, because a lot of the liquidity was there channeled into risk assets and not into the real economy. The examples where you've seen big increases in liquidity and pickups in economic activity have been generally periods where fiscal policy is actually enacted at the same time. Well, in other words, the government's deficits have been monetized. Governments have used the cash rather like an MMT process directly. Now, you could actually argue, and I think this is a legitimate thing to think about, is that if you look at Asian policy in the last 30, 40 years of window guidance, that is an extremely instructive thing to think about for Western policymakers, because that's been a hugely successful policy in terms of driving faster economic growth. And it started with Japan through the window guidance that the banks operated under control by the Ministry of Finance and the Bank of Japan. And what they did is they selected certain industries and they basically forced or compelled the banks to give easy credit for certain industries, of which I think there were 5 or 6 that were designated. The Koreans then followed that line. I don't know exactly if it's true, but I suspect that Taiwan did much the same. And China has been doing exactly the same thing recently. So this directed lending is a way of actually forcing liquidity into financial markets. Now, again, if you come back to a Western example, that was again probably what happened after World War II, when you saw an expansion in liquidity and you equally saw the real economy picking up greatly without the response of the bond market. So the bond market didn't really become troubled by that. Now, one of the reasons that the bond market didn't become troubled was that the US authorities were operating a yield curve control, but it was much easier for them to do that then, simply because 40% of the bond market was then owned by the banks and under 5% was owned by foreigners. Now you've got the reverse situation. The banks own about 5% of the government bond market and foreigners own 40%. So the ability of the Federal Reserve to control the bond market, I think, is more limited. One other thing to say is that then if you start to look at monetary growth periods, for example, the period after World War II, you find actually that expansions and contractions in monetary growth, M2 as it was then, actually are very good lead indicators of upcoming inflation. So everything is pointing to a faster inflation outcome.
Yes, yeah. So without, just don't want to monopolise your time, Michael. I just find the point that you make about the situation with US debt suggesting that inflation is definitely the likely outcome, but is it stagflation or sort of a Taylor rule type growth and inflation? Output gap. Yeah.
I think the answer to that is I think that you're likely to see, at least in the near term, a much faster growth rate coming out of the US economy. And part of the reason for that is what I alluded to about more technology being taken up and that becoming more widespread or deepened across the economy. But I think the other thing is that what you're seeing, and this will occur, I think, through whichever presidential nominee takes office in November, or actually accurately next January, whoever takes office is likely committed to a major spending program in the US. And the way that they're going to do it, without any great surprise, is through this mechanism of so-called MMT. They won't call it MMT, and MMT is not really a theory and it's not really a new idea. It's simply saying we're going to monetize government deficits. And that's really what the Federal Reserve is committed to. So whether it's Biden's green agenda or whether it's a Trump-led infrastructure program, there's going to be a lot more spending. And because it's going into the real economy, by definition, you're going to see faster growth coming out of that. So I think that, in my view, the next few years will likely see a faster trend growth rate rather than a slower one. What is that going to mean for the debt burden? Well, while you've got still whopping great government deficits, it's going to be very difficult to get the aggregate debt GDP ratio down in the US. Even if you use financial repression, the maths don't work. But you will get a shift of the debt burden from the private sector to the state sector. And that maybe is what's needed.
Thanks, Michael.
Good. Let me run through some other questions. There's one from Jeff which says, is the strong euro compatible with a pickup in Eurozone inflation and strong European equity markets? Well, the answer is kind of less so. I think the problem is that we know that the euro area is basically deflationary for a whole number of reasons, probably demographics being a paramount factor. But what you've got is against that the risk that the euro is going to pick up, and that's what is spooking European policymakers. And I think the issue is that whereas the Asian central banks and governments and the US central bank and government have got a lot more control over their currency, it strikes me that the ECB doesn't really have that control. If it tried to exercise that control by printing money, what would the German authorities say? They would be sort of aghast against that. So I think the path of least resistance, in fact, many ways the residual, is that the euro has to appreciate. Now, they'll try and do everything they can to stop that, but I would suspect that their reaction will be to use more fiscal policy. If they use more fiscal policy, then I think you're going to see an even stronger euro. So what does that mean in terms of European equities? I think it means that they have a problem in this regard if this outturns, for the simple reason that effectively, as long as I've looked at European equities, they tend to move pretty closely with Wall Street, with the caveat that the exchange rate, is responsible for relative movements, relative performance. Let me another one, which is let me do another one, which is what would you expect if US-China decoupling accelerates in the coming months? Would we see a hard break or even an outright great power war? Well, the answer to that is I think we would see probably all of those things. I mean, I think that, are we looking at a divide between China and the rest of the world? My answer is yes, we are. I think that the Chinese are preparing for this anyway in a number of ways. And let me sort of try and clarify that. One of the things you're seeing right now is a build-up of a restocking of China of major resources, oil, copper, etc. We've heard a lot in recent years about how China controls a lot of strategic minerals. That's true, but the basic raw materials China doesn't control. And China still needs to import a lot of basic raw materials worldwide, particularly and above all food. China cannot feed itself, and it needs to import food, and that's where the US plays a key role. Now, one of the things that I would suspect is going on, and I'm not a geopolitical analyst, but I'm putting two and two together, is that the US has announced two things very recently, which are going to try and stymie China's attempts to draw in these raw materials. One is an expansion of the US fleet to try and match what China has done, and the other is the initiatives in the Middle East. Now, the initiatives in the Middle East to try and create a united front, basically, I would say, mean that it's very difficult for China to pick off different countries now. And it is giving, if you like, a degree of freedom to the Middle East to try and negotiate itself without the presence of the US. So it makes it more difficult for China to operate and to get good or cheap oil deals, perhaps. The reason that the US fleet has been expanded is that the whole ethos of world trade is being backed on the idea that you can sail from A to B wherever you like with the knowledge that you're being protected implicitly by the US fleet or by the US military. If the US is extending its power now, it's going to be very difficult for freedom of navigation for potential enemies such as China to enact that. And the US is making that bit more difficult. So I think what's going on is that there is a very clear divide between these two areas. What about China's own initiatives? Opening up the bond market is one of those. And already you've seen in the last quarter, $50 billion of foreign capital going into China, which is $200 billion at an annualized rate, entering their bond market. Why is China enacting swap lines right around the Asian region, including the Belt and Road Initiative countries? It's because they're soon going to denominate more of their trade in yuan. And what is the point about the digital yuan? It will enable peer-to-peer transfers and disintermediate the dollar. So I think the answer is yes, you are seeing a clear divide between China and maybe the rest of the world. But I think from what I'm saying is the curiosity in that mix is that Asian countries seem to be aligning their currencies more and more with the yuan or within an Asian bloc. So basically, I would say that the answer to that question is that we are having a power war, but that probably tells me that you want to be moving into commodity prices and you want to be moving into gold. And that was exactly what you should have done if you go back to the 1930s when there was a scramble for resources. Another question about China selling 200 billion of US treasuries. How does it square with attempts to hold the renminbi stable? It does, for the simple reason that what you've got now is that the Chinese are redirecting capital internationally. If you look at what's going on, and this is true, if you like, generally across the Asian countries, basically trade surpluses have picked up recently. And what you have been seeing generally is flat to rising foreign exchange reserves. Now, the reason that foreign exchange reserves are not going up more aggressively is probably for cosmetic reasons, because it would be an alert to the US authorities that there's maybe some currency manipulation going on. So what's happening is that sovereign wealth funds are actually using some of that money to channel abroad, or what the Chinese are doing is they're redenominating their holdings of dollars into euros. They may be giving more lending out or direct investment to Belt and Road Initiative countries. They're actively using the private sector to deploy, if you like, these capital inflows more and more. And that will mean that they can live with a flat currency while seeing strong capital inflow. That would be my answer to that. another question, which is, would wealth liquidity flowing through the EU be enough to support Chinese liquidity, or would a financial decoupling starve China of capital? What if the world splits along a new alliance lines? We assumed the EU drags its feet on making a decision and tries to remain a third pole. I think the answer to that is yes, I kind of agree with all that. I think that basically what I would suspect is going on is that the clear geopolitical initiative that the Americans have to make is to divide, or to make sure that China and Russia stay divided. Okay. Now, in some ways that's happening, but in some ways it's not. And this sort of takes us back almost full circle to geopolitics back into the 1970s. And the decision, or the alacrity with which Nixon and Kissinger jumped towards China to basically separate China from Russia in the 1970s, are in many cases what wealth in the last 3 or 4 decades have been built on. That whole idea about reintegrating China into the world economy, and now we realize it's gone too far. What they cannot do is to allow China and Russia to join up again as a foe against the West. Now, I think there are 2 solutions to that, in my view, and this may be pure speculation. But one of those is that Turkey is now an independent country and an independent voice in the Middle East, which is likely to mean that Russia is preoccupied there and cannot rely on a predictable Turkey. In other words, Turkey is outside of stepping outside of NATO in that regard. But it's actually trying to dominate the Middle East in its own way. The second thing is that I think Germany is moving more and more closer to Russia. And in the book that I wrote called Capital Wars, I tried to articulate or quantify that by looking at German fixed direct investment. And one of the things that I noted in that is there's been a phenomenal change in the location of German FDI from the West, including France and the United States and Spain, into Eastern European countries, Central Asia and Russia. And that's remarkable. And what that's saying is that German industry is voting with its feet, and the Eurozone is going to get pulled more and more eastwards. So I think that that's how the geopolitics work out. So you are trying to see Europe as a separate pole, but ultimately I think that will fail because the rise in the euro and the strength of the German economy is going to, if you like, disenfranchise the Mediterranean countries, and there'll be, a lot of tensions within the eurozone. And let me go through a last couple of ones. Question here about what is the time horizon for 210 yield curve steepening? Well, I would say basically within 12 months. I think that it's happening. I think that that as soon as you start to see a sniff of inflation, you will begin to see bondholders panic and try and sell their bonds to whoever they can, and that flood will basically will be too big for the central banks to take. Now, one of the interesting pointers to that is, or 2 pointers. One is, when will inflation restart? Well, I think what you've got is a very big base effect in inflation rates now, caused by the collapse in oil prices. When that comes out of the year-on-year comparisons, you'll begin to see inflation picking up more visibly. One of the other things to look at is something like the supplier deliveries question in the US ISM, which has always been an extremely good predictor of upcoming inflation. And that has been elevated really since the COVID crisis. And that's suggesting that there are supply shortages in certain areas. And that's really how inflation starts. The other thing I think to note is why the Federal Reserve decided, according to the FOMC minutes, not to formally enact yield curve control. And their reasoning was that if they did, they would completely lose control of their balance sheet in the example where domestic investors or foreigners just want to put their bonds to the Fed. The Fed would just have to take them, and the balance sheet just zooms to the moon. So I think 12-month horizon, and I think that the yield curve could steepen quite markedly. The other thing I would say as a corollary to that is that what we're talking about in all these things is a big rotation within equity markets from growth to value. So if commodity markets go up, the yield curve steepens, all these factors, you're going to be seeing value beginning to take off. Another question is, what if China and Russia do join up to form a new axis? Is that happening already? And it's not just geopolitics. What does it mean for liquidity in markets? Well, I think maybe I've tried to explain that. I think maybe not very well. I think the answer is that if you think, what does it mean for markets? I think what it means for markets is that commodity markets are going to move up significantly. And we've got to look at this in maybe 3 different areas. One is basically, or maybe 4 areas. One is the gold price. Well, the gold price is going to go up a lot more if this is the case. Already, Russia and China hold over 20%, I think it is, of world gold reserves themselves. And that's been built up from virtually nothing over the last 15 years. So they're really anticipating some change. In terms of specialist minerals, China has a monopoly on a lot of those, and that clearly is going to be a problem. One of the things Western governments are trying to do now is to open up old mine shafts and try and use latest technologies to actually extract some of those rare earth minerals themselves from existing sites, although that's easier said than done in the short term. So there'll be a problem in that regard, in those supplies. In terms of more conventional raw materials like copper, aluminum, oil, etc., there's clearly going to be a rush to get access to those. And I think those commodities are going to keep going up or remain elevated. So I wouldn't expect to see the oil price much lower than where we are now. But the price of copper and the price of platinum and whatever palladium could be significantly higher than where we are. And then it comes back to the 4th item, which is food. And food is a commodity which is likely to be really strained in this environment for the simple reason that neither the Soviet Union, or actually a little bit less true of the Soviet Union now, or Russia, is unable to provide food for its populace. Now, the big failing that the former Soviet Union had through the 1970s and 80s was an inability to feed itself, and grain production was way down, etc. One of the things that Putin has achieved beyond anything else, apart from making himself a nuisance, is he's actually got Russian agriculture back onto a firm footing. So Russia again produces surpluses. But the fact is that China is still a voracious consumer of food products from around the world. And that's one of the easiest ways to put a squeeze on China. So what they're doing now is they're stockpiling what they can. So I think that my answer to that would be, number one, you're likely to see, in terms of commodity markets, rises across the board, particularly in things like gold, but also food commodities. You're likely to see, generally speaking, equity markets, I think, benefit from these moves. Bond markets are the area which are much more compromised, particularly if governments have to enact a lot more defense spending, because that's certainly going to have to be paid for in some dimension. And I think from what the US is doing, that clearly is on the agenda. In terms of liquidity, it's a very difficult point. And it comes back to looking at one of the main sources of liquidity in the world economy over the last 10, 15 years has been the Chinese private sector and Chinese banks. And I think what you're seeing is maybe less of a global liquidity picture and much more of a regional picture. So I think China is going to be much more important for the Asian region as a source of liquidity. And already financial markets and emerging markets attest to that, because the cap on emerging markets is correlated very closely with tight central bank policy in China, whereas the US and the Eurozone are going to be much more sources of liquidity for Western markets. And again, that ultimately probably comes down to the US Federal Reserve, because the ECB, as we've said, is at the end of the day compromised. Let me see if we've got any more questions. I think that's it as far as I can see. in which case, if there are not any more, I thank everybody for their time. I apologize profusely for not being able to finish the slides. I'll send them around, and if there is an appetite for a follow-on call, we'll certainly go through that. Maybe as a matter of due diligence, we ought to do that anyway in a couple of weeks to see if anyone's interested in listening to the end of that presentation. Thanks again for your time.
Thank you very much to everyone, and apologies once again for the technical difficulties. We will send around the presentation afterwards. Thank you very much.
Thank you. Bye.